Hi, Assalamualaikum and a very good morning to Mr. Mustafa. Kamal bin Mat, our lecturer for the subject financial management. I would like to say my thank you to my team member MEYSHERA and also ZULAIKHA for helping us together in working out in this subject. So we have been given a task to presentation about the case study, the company, the police, Sdn Bhd, the PSB. So what is the PSP? PSP is involving with the polythene industry for business to business. So polythene has been led by the Encik Rahim, the eldest of the brothers, of four brothers, as CEO, while Mr. Yusri as marketing, Mr. Zulkifli as human resources, and also Mr. Nordin for the finance itself. So later when the company go bigger and bigger, so they moved to Alor Gajah in Melaka in 1996 with the capital of 78 employees. So we move to the next slide. So there are a total of 5 issues that need to be taken into the consideration very seriously by the PSP to prevent them from losing more money in the future year. So the first one is about the software in storing the financial data. Because as you know that PSB currently they're using the all type of school software lah to store the financial management for the suppliers, for the staff, for the employees, and also for the customer. So this kind of hectic and sluggish and because it's very slow to process any financial data is not fully automated. It needs to be key in database. And the second one is about the strong seniority and the strong culture. As we know that this company has been led by four brothers. The first one is as the CEO, Encik Rahim. He has, we can say, veto in choosing any opinion that can jeopardize the company's operation himself. The third one is about the legal contract. As we know, the experience by the Encik Rahim itself with the other two big companies are using only verbal contract. There's no written black and white agreement. So it's kind of risk to the company. The fourth about the loan liability. As we know, the ratio from the loan liability and with the profit and sales is not that great because we can see the loan that been applied by this company year by year is very huge compared with what they got in the net income. And the last one is about the business diversify. As we can see, the PSB only focus on one kind of segment in the polythene industry. They are not focusing in other segment in the same polythene industry, but for the other segment other than B2B business only. So we move to the next slide.
This is a bar graph for common size statement analysis for the both year 2011 and 2012. For current asset, it shows that in 2012, cash in the bank inventories trend better. Debitor is a little bit increased than 2011. Meanwhile, the debitor and fixed deposit is decreased in 2012, and the both total current assets compare not much different, but decreased in 2012. For non-current assets, the both non-current assets compare not much different, but increased a little bit in 2012, just for vehicle got decrease. For current liability, the both show that compare not much different, but in 2012, bank overdraft due to the better lower but other getting a little bit increase. For non-current liability and equity, the both show that compare not much different, but in 2012 everything increased just a little bit than last year. As you can see, this is a table for common size analysis income for Sdn Bhd in 2011 and 2012. The net operating income or earned after interest and tax represent in 2011 was 3.58% of the total revenue, and it showed the healthy of the business core operating area, but the net income can be compared to the previous year net income to see how the company performance year on the year. In 2011, it showed that 0.34% only for the net income, and it's a little bit lower than 2011. This indicate the company is losing revenue or incurring additional expenses. As a result, the company has taken salary deduction to ensure that the business operate at normal capacity.
Before we go any further on the cash cycle, let us discuss on days inventory outstanding, days sales outstanding, days payables outstanding, and operating cycles. So days inventory outstanding is the average number of days company holds its inventory before selling it. So the lesser the days inventory outstanding are, the healthy the financial health of the company. For Police Sdn Bhd, there are a reduction for days inventory outstanding, which is 48 days to 39 days, which is quite big, and yet it still needs some refinement. Meanwhile, days sales outstanding is the average number of days taken by a firm to collect payment from their customer after the completion of a sale. So, the lesser the days sales outstanding is, the healthier the financial of the company. In Police Sdn Bhd case, days sales outstanding only reduced by one, which is from 44 days to 43 days. Furthermore, days payables outstanding stands a meaning of financial ratio that indicates the average time that a company takes to pay its bill and invoices to its creditors. So, the more the number of days payables outstanding are, the better it is. For company Police Sdn Bhd, there are decreases from 56 days to 50 days. They should maintain a higher days payable outstanding for a better financial health. Next, operating cycle refers to days required for a business to receive and sell the inventory and collect cash from the sale of inventory. This cycle plays major role on defining the efficiency of a business. So, the lower the operating cycle, the better it is. Police Sdn Bhd shows an improvement on operating cycle as it reduces 10 days from 92 days on 2011 to 82 days on 2012. Lastly, cash cycle is the number of days it takes to a company to convert cash on hand into inventory and back into cash again. And a good cash cycle is a short one. So Police Sdn Bhd indicates breakthrough as their cash cycle decreases from 36 days to 32 days. Okay, thank you.
Zulkifli. Today I will present about implication to the financial position. Implication to the financial position for Police Sdn Bhd in debt ratio in 2011 until 2012 is debt ratio get a high ratio indicates that debt financing make up the majority of a company's funding. This is a dangerous financial structure because the borrowers runs the risk of being unable to cover the interest cost or repay the principal. Besides that, Police Sdn Bhd cash flow are very high and the company is not able to reliably pay down the debt. Police Sdn Bhd has more debt than assets and the debt ratio is higher than 55%. This company has more assets than debt if its debt to equity ratio is less than 55. At the same time, leverage is an important tool that companies use to grow and many businesses find suitable uses for debt. On the other hand, implication for the time interest earned for Police Sdn Bhd is they receive a fewer earnings that are available to meet interest payment that just 1.31 times in 2011 and 0.88 times in 2012, and it is decreased. This is evidence that this company failed to meet the industry average that 35 times and the company result is under 35 times that is lower than industry average. This situation could force Police Sdn Bhd into a bankruptcy because it is used by both lenders and borrowers to determine a company debt capacity. Next, implication for the debt equity ratio is poor because the result of Police Sdn Bhd are 3.22 times and for 2011 and 2.85 times for 2012 and it's above 1.0 times for industry average. The poor result of debt to equity ratio is bigger and it does not require any money to finance its business and operation for growth. This is because of Police Sdn Bhd own capital than borrow capital generally. Finally, the cost of capital for loan capital is frequently cheaper than for equity capital. Ignoring this chance could lower company potential profitability and slow down overall growth. Lastly, for the implication on equity ratio is poor because the result of a company is 23.67% on 2011 and 25.97% for 2012. This is because it's under industry average, that's 60.10%. Result of company is below is considered a leveraged company. The lower the value is more leverage this company will be. Equity ratio with lower value generally indicate that this company not effectively funded its asset requirement with a minimal amount of debt. This company will more prone to lose for a large portion of its earning than spent in paying interest. Lastly, it will be Sdn Bhd more difficult to obtain loan from banks or other financial institutions, and if they manage to get loan, it is comparatively get high interest rate.
So as you can see, this is the financial position between 2011 and 2012. As you can see, the asset has been decreased between 18 million to 16 million, 2 millions difference. The liability about the 14 million to 12 million, 2 million decrease. So it's good. So the equity 4 million to 4 million 500. So there's slight increase. It's not that good. The sales about the 17 million to 16 million, almost 1 million half loss in sales, and also the net income reduced by half between the 138,000 in 2011 and to 55,000 only in 2012. So this kind of trend is not that great. So we move to the next slide.
Liquidity issues for Sdn Bhd in 31 December 2011 to 31 December 2012 have a poor result because the result is under industry average. Both year in 2011 and 2012, Sdn Bhd increased its commitment because it has a larger amount of current liabilities value relative to the value of its current asset. Therefore, it shows that the company is not able to fulfill their current obligation with their available current assets. As for 2012, Sdn Bhd is short-term debt obligation because it has a little more liquid and has a little left over more than 2011. In both years, Sdn Bhd was high in quick ratio. The company has not enough liquid asset to meet in short-term commitment, and assets can be quickly liquidated into cash than current liabilities. So Sdn Bhd deteriorated its liquidity this both year, which in this case is bad as it is operating with relatively high liquidity. It needs to improve and increase the quick ratio so it won't have to sell inventory to meet its short-term debt obligation. For 2012, Sdn Bhd net working capital was negative 908, so its net working capital position has deteriorated from 2011 to 2012.
Time interest earned ratio (TIE) is interest coverage ratio. It shows the company can cover its interest payment of pre-tax basics. The greater the time interest earned, the more able the company is to pay interest on the debt. In addition, it aims to measure the company's ability to continue to pay its debt as well as find out whether the company is facing financial problems or not. Based on the time interest earth ratio (TIE) for Sdn Bhd in 2011 was 1.31 times, while in 2012 it was 0.88 times. It showed the interest ratio time in this lower situation also means less income is available to meet interest payment. However, if the company fails to meet its obligations, this can cause the company to go bankrupt in both the lender and the borrower in determining the debit capacity of the company. Sdn Bhd is advised to reduce debit if it want to increase time interest at TIE. This is because if they do not take any action, it will cause the company to go bankrupt, and no investor will dare to take the risk of investing in this company.